Welcome back to American Trade. Tonight, the global economy is entering a dangerous new phase. The Federal Reserve is trapped between inflation and slowing growth. Markets are pricing in uncertainty. Gold is surging. Geopolitical tensions are reshaping global trade routes. And investors everywhere are asking one question. Are we headed toward a new economic boom or the beginning of a global financial reset? Let's break it all down. The biggest force moving markets right now is still the Federal Reserve. After years of aggressive interest rate hikes designed to crush inflation, the Federal Reserve now faces a difficult reality. Inflation has cooled from its peak, but it hasn't disappeared. At the same time, parts of the economy are clearly slowing. Higher interest rates have hit commercial real estate, regional banks, credit card debt, auto loans, and small business. Consumers are also feeling pressure from higher prices on food, housing, insurance, and energy. The Fed's problem is simple. If they cut rates too early, inflation could surge again. If they keep rates too high for too long, they keep pushing the economy into another recession. For that, the uncertainty is why markets react so violently to every inflation report, jobs report, and Fed speech. Right now, investors are watching for clues about future rate cuts, liquidity injections, and whether the Fed is secretly preparing for economic weakness behind the scenes. And here's what makes this cycle different. Government debt levels are now enormous. Higher rates don't just hurt consumers, they dramatically increase the cost of servicing U.S. debt. That means monetary policy is no longer just about inflation, it's also about sustaining the financial system itself. The American consumer has carried the economy for years, but cracks are starting to appear. Credit card balances remain elevated. Buyers are hesitant, inventory remains tight, and affordability has collapsed in many regions. Meanwhile, commercial real estate continues to face pressure from remote work, refinancing risk, and declining office demand. This matters because banks are heavily exposed to commercial property loans. At the same time, manufacturing and supply chains are beginning to reshape geopolitics. The United States is increasingly trying to bring production back home, reduce dependence on China, and secure strategic industries like semiconductors, energy, and defense manufacturing. That shift could create long-term investment opportunities, but it also increases costs in the short term. Globalization is no longer the uncontested model it once was. The world is moving toward economic blocks, and markets are adjusting to that reality in real time. Geopolitics is now directly influencing markets every single day. Conflicts and tension in Eastern Europe, the Middle East, and Asia are impacting energy prices, shipping routes, defense spending, and global trade flows. One of the biggest flashpoints remains Taiwan. Taiwan dominates advanced semiconductor manufacturing, the backbone of modern technology. Everything from AI systems, smartphones, military hardware, and automobiles depends on chips. That's why the U.S. is aggressively investing in domestic semiconductor production. At the same time, countries around the world are attempting to diversify away from overdependence on any single nation. We're also seeing the rise of alternative financial alliances. Nations associated with BRICS continue discussing trade settlement alternatives, commodity-backed systems, and reducing reliance on the U.S. dollar. Now, the U.S. dollar still dominates global finance by a massive margin, but even small shifts in global reserve behavior matter over time, especially in a world where debt is rising, sanctions are expanding, and nations are prioritizing strategic independence. This is no longer just economics, it's economic warfare. Markets today are behaving and are also being driven by two competing forces, fear and optimism. On one side, investors worry about recession, debt, inflation, and geopolitical instability. On the other, artificial intelligence, automation, energy infrastructure, and reshoring industries. These are creating massive excitement. AI has become one of the dominant themes driving market momentum. Major tech companies are spending billions on chips, data centers, cloud infrastructure, and AI development. That spending boom has fueled parts of the stock market higher, even while other sectors struggle. At the same time, many investors continue moving into hard assets: gold, silver, commodities, and select real estate. Gold especially has benefited from inflation concerns, central bank buying, geopolitical uncertainty, and long-term concerns about debt and currency stability. Bitcoin and crypto remain highly volatile, but continue attracting attention as alternative financial systems evolve. The next few years may define the future of money, global trade, and the balance between centralized and decentralized finance. The global economy is entering a period of major transition. The old system of cheap money and endless globalization is changing. Now the world faces higher interest rates, rising geopolitical tensions, technology disruption, and a battle over the future of the global finance itself. The question is no longer whether markets will change. The question is, who will adapt first? If you enjoyed the breakdown of the economy, markets, geopolitics, and the Federal Reserve, subscribe to American Trade. Because in a world changing this fast, understanding the trends may become the ultimate advantage.